Imagine owning like 1,500 gas stations in an era where literally everyone is terrified that electric vehicles are just gonna, I don't know, completely wipe out long-term demand for gasoline.
Yeah, you'd probably think the business model is totally doomed.
Right. But today's company just paid its 17th consecutive dividend increase, and they're yielding over 6%. Welcome to the Byte-Size Brief. Today, we are putting GLP, that's GLP, completely under the microscope. Let's get into it.
It's a fascinating one.
It really is. Usually when we look at the energy sector, it feels like everything is just tied to the unpredictable swings of crude oil prices. But today, we're looking at a company that operates essentially as, well, the critical plumbing of the fuel supply chain.
The plumbing is a great way to put it, yeah.
And they are making some incredibly aggressive strategic moves right now. We've got a really robust stack of fresh sources on the table for you today. We're talking recent earnings transcripts from Q3 and Q4 2025, SEC filings, some very revealing S&P Global ratings reports, and a curious little cluster of insider trading data from just the last 3 months.
Yeah, it's a phenomenal stack of data to work through. And really, the mission for this deep dive is straightforward, right?
Yeah.
We need to determine if GLP is a hidden value gem or if it's just a yield trap for retail investors who are trying to navigate the very complex, highly regulated energy and convenience store sectors.
Because on the surface, GLP looks like an absolute dividend powerhouse.
Right. Yeah.
But when you start digging into the financials and, those recent quarterly swings, the story gets incredibly layered. So to really understand GLP's stock and where this company's actually headed, we first have to understand their physical footprint.
Which is shifting dramatically.
Exactly. If you live near the Northeast, you might be familiar with them, but they're expanding geographically, making some really bold leaps down south.
Yeah, historically, when you think of GLP, you think of New England. But their recent Texas ambition, it represents a really profound shift in their corporate narrative. They recently executed a joint venture with ExxonMobil to acquire 64 time-wise convenience stores right in the Houston area.
64 stores in one go. That's huge.
It is. And they aren't just letting those stores operate status quo either. They are actively rebranding about 40 to 50 of them to their own Honey Farms banner as we speak.
And if you're familiar with the brand, before this Texas move, their Honey Farms footprint was remarkably small. It was just like 11 company-operated stores, mostly clustered around Massachusetts.
Yeah.
So with the single swoop into Houston, they're exploding that brand to 75 stores across 2 entirely distinct regions. I mean, it is a substantial physical leap.
It is, and they're backing up that retail expansion with some serious logistics infrastructure. They're pushing really hard into the Houston bunkering market.
Which is marine fuel, right?
Exactly, the marine fuel supply business for cargo ships and tankers. But what's really interesting is the mechanism they're using to do it. Management calls it a CapEx light model.
Yeah.
So instead of spending hundreds of millions of dollars building new terminals and shipyards outright, they are utilizing leased barges and leased terminals.
Oh, smart.
Yeah, it gets them immediate market share in one of the biggest fuel hubs in the world. And that strategy perfectly leverages their broader terminal acquisitions, specifically the 25 refined product terminals they bought from Motiva for $305 million.
So they are effectively building an entire liquid energy ecosystem down in Texas basically overnight, but keeping the initial capital expenditure relatively low by just leasing the moving parts.
Precisely. But, you zoom out for a second and look at the broader convenience store industry right now. It is going through this really profound kind of existential transition. Major chains are frantically trying to adapt to alternative fuels.
Yeah, totally.
You've got governments pushing really stringent EV mandates. European markets are setting hard dates to phase out internal combustion engines. And there are super strict CAFE standards in the U.S. dictating fuel economy. So there is this underlying systemic panic among retail operators about long-term retail fuel demand eventually just dropping off a cliff as more electric vehicles hit the road over the next decade.
Right, but what does all that actually mean for GLP investors?
Good point. Well, it means that GLP's specific operational strategy is actually a built-in hedge against those exact macroeconomic EV risks.
Oh, really? How so?
The reason they can weather those fears is their vertically integrated model. I mean, they aren't just a franchise gas station operator crossing their fingers that people keep driving traditional cars. They own the massive liquid energy storage terminals, they control the wholesale distribution logistics, and they own the retail stores at the end of the line.
Ah, okay. The whole pipeline.
Exactly. By controlling the physical product from the bulk storage tank all the way to the actual pump, they capture margin across the entire liquid energy chain. So if retail demand softens slightly in a specific region, their wholesale or terminaling operations can adjust and pick up the slack by supplying third parties or leaning into commercial logistics.
Okay, so compared to last quarter, what actually moved the needle here? Because owning the whole chain sounds great in theory, but how is this integrated model actually showing up in their recent quarterly results?
That is where the financial data gets truly fascinating, especially when you contrast the third quarter of 2025 with the fourth quarter. We saw a really stark seesaw effect in their business segments.
A seesaw. Okay, let's start with Q3.
Right, so in the third quarter, GLP suffered a noticeable drop in adjusted EBITDA. And for those unfamiliar, adjusted EBITDA is essentially their core operating profitability, so earnings before interest, taxes, depreciation, and amortization.
Got it.
That metric pulled down to $98.8 million. And management heavily blamed that drop on lower fuel margins in their retail segment, which they call GDSO. That stands for gasoline distribution and station operations.
Okay, so the retail side.
Right. So in Q3, the retail pumps took a hit, but their wholesale segment actually performed very strongly to help cushion the blow.
So retail was the drag and wholesale was the hero holding the quarter together?
Spot on. But then, and this is the wild part, we roll into the fourth quarter of 2025, and the complete opposite scenario played out.
Really?
Yeah. The GDSO retail segment suddenly became the hero of the quarter. Retail fuel margins actually spiked by 9 cents year over year, hitting 45 cents per gallon.
Wow, 9 cents is a big jump for gas.
It is. Now, the reason that happened is tied to the volatility in wholesale gas prices, specifically RBOB prices. RBOB stands for Reformulated Blend Stock for Oxygenate Blending.
It's a mouthful.
It is. It's essentially the raw, unblended pan-based gasoline that gets traded on commodities markets before the ethanol is added.
Yeah.
When RBOB prices fall rapidly on the wholesale market, retail gas stations tend to keep their pump prices sticky for a few weeks.
Oh, yeah. They don't drop the price for the consumer immediately.
Exactly. And because of that lag, GLP's retail product margin shot up 8.3% to $231.3 million.
That makes perfect sense. The cost of their inventory dropped way faster than the price they charged the driver at the pump.
Exactly right. But, on the flip side of that exact same coin, their wholesale product margin completely tanked by 26.9%, dropping down to $58.3 million. Management cited unfavorable market conditions, which is basically corporate speak for taking a mark-to-market hit on their wholesale inventory when those underlying commodity prices fell.
So basically, it's kind of like a financial seesaw. When the retail gas stations take a hit because wholesale prices are rising, the wholesale side lifts them up. And then when wholesale inventory values drop, the retail stations make a killing on the sticky pump prices.
That is the absolute perfect way to visualize the mechanism. And that seesaw effect is actually the core argument CEO Eric Slifka was making during the earnings call.
Oh, really?
Yeah, he stressed that these contrasting results prove the durability of a diversified, integrated portfolio. Because different parts of the liquid energy supply chain experience completely different market conditions at different times, the integration provides multiple alternating sources of earnings to balance the overall performance across volatile commodity cycles.
Which is, the primary characteristic you want if you are holding the stock for stability. And I know we're looking at late 2025 data here, but you brought up a really interesting current tailwind for the beginning of 2026.
Yes, the recency data is very compelling here. If we look at the first quarter of 2026, GLP is already seeing a significant operational tailwind.
From the weather, right.
Exactly. We experienced a severe cold snap in the Northeast in late January and February, and that weather event massively drove up a metric called heating degree days.
Heating degree days.
Right. It measures how many degrees the average daily temperature falls below 65 degrees Fahrenheit. It's basically the standard industry trigger for when buildings automatically turn on their furnaces.
Gotcha.
And because GLP is heavily concentrated in the Northeast, those heating degree days directly drove up wholesale heating oil demand. So that wholesale segment that really struggled in Q4, it's likely getting a very strong boost right now.
That's the beauty of moving physical energy, right? When the weather turns freezing, the demand is just entirely inelastic. People have to heat their homes. So the cash flow easily covers the dividend today. But, a dividend is only safe if the underlying financials supporting the company are actually sustainable. Let's look at their massive payout and their heavy debt load.
Yeah, the dividend is always the primary point of contention with master limited partnerships.
It is, and I get incredibly excited when I see a yield like this. I mean, we are talking about a 6.6% dividend yield for GLP. That's $3.04 annualized. And they literally just issued their 17th consecutive distribution increase, pushing it to 76 cents per unit for the quarter.
It's impressive.
But, and this is a glaring issue, I was reading through one of the analyst reports in our stack, and it highlighted a truly terrifying metric, a 144% payout ratio.
Ah, yes.
Hold on, a 144% payout ratio? That sounds like paying my mortgage with a credit card. How does that actually affect GLP's stock price for regular investors like me? Is this dividend a trap?
I completely understand why that 144% number sets off immediate alarm bells. I mean, if GLP were a traditional C corporation, a payout ratio over 100% would absolutely mean they are borrowing money or just burning through their cash reserves to pay the dividend.
Right.
That would be a glaring red flag. But we have to look through the lens of Master Limited Partnership, or MLP, accounting rules.
Okay, unpack that specific accounting mechanism for us.
Sure. So when you look at that 144%, you are looking at the net income payout ratio. And net income includes really substantial non-cash accounting deductions.
Like depreciation.
Primarily depreciation, yes. GLP owns billions of dollars in physical assets. I'm talking 49 massive liquid terminals, over 1,500 gas stations, barges, trucking fleets. The depreciation on those physical assets absolutely crushes their net income on paper.
Right, but it's just on paper.
Exactly. Depreciation doesn't cost them actual cash out of their bank account today. For MLPs, the metric that actually dictates dividend safety is distributable cash flow, or DCF.
Distributable cash flow. So basically the actual cash generated by the business operations that they can legally hand over to unit holders.
Precisely. And in Q4 of 2025, their DCF was a very healthy $38.4 million. When you divide that by the actual dividends they paid out, you get a distribution coverage ratio of 1.56 times.
Wow.
Yeah, that means they generated 56% more cash than they actually needed to pay that 6.6% yield. So the dividend is incredibly well covered by actual cash flow, despite what the net income ratio implies.
Okay, so depreciation is a paper loss, kind of like a new car dropping in value the second you drive it off the lot. But GLP still has to physically maintain 1,500 gas stations and 49 terminals. Doesn't that take real hard cash? I mean, does distributable cash flow actually account for those real-world maintenance costs, or is it just another clever accounting trick to make the yield look safe?
That is a critical distinction to make. And yes, DCF absolutely accounts for maintenance.
It does.
Yes. To calculate distributable cash flow, MLPs take their operating cash flow and they actively subtract maintenance capital expenditures, which is the actual cash required to fix leaky roofs, upgrade fuel pumps, keep the terminals compliant with safety regulations, all of that. What they don't subtract is growth capital expenditures, like buying those 64 new stores in Texas. So that 1.56 times coverage ratio. That means they fully paid for the upkeep of their existing infrastructure and still had a 56% buffer left over after paying the dividend.
All right, that thoroughly changes the narrative from yield trap to a genuinely sustainable payout. But what about the leverage? I mean, they've been buying all these terminals from Motiva and Gulf Oil. Scaling up physical infrastructure requires debt.
It does require debt, and they funded those 2024 acquisitions using the revolving credit facility, which temporarily pushed their leverage ratio above 4 times.
That's pretty high.
It is, however, S&P Global Ratings just stepped in and revised GLP's outlook to positive from stable. S&P expects the steady, contracted cash flow from those newly integrated Motiva and Gulf Oil terminals to rapidly reduce their leverage below 4 times by late 2025 and into 2026.
Wow. Securing a positive outlook from S&P is a significant endorsement in this fluctuating interest rate environment. And it seems like the equity analysts are agreeing with the credit analysts on this one.
They are completely aligned. Zacks currently ranks GLP as a number 2 buy with an A for their value grade. They highlighted a price-to-book ratio of 2.73 and a price-to-earnings ratio of 14.79.
Break those ratios down for us. Why are those specific numbers attractive for an asset-heavy pipeline and retail company?
Sure. So a price-to-book ratio of 2.73 means investors are paying just under 3 times the liquidation value of the actual physical dirt, steel, and concrete the company owns.
Okay.
For an entity generating this much free cash flow, that implies you aren't paying a steep premium for their future growth. And a PE of 14.79 means you are paying about $15 for every $1 of earnings. In today's broader market, where tech stocks routinely trade at 40 or 50 times earnings,
Or more, yeah.
a 14.79 multiple for a company actively growing its footprint and paying a fully covered 6.6% yield is turning a lot of institutional heads.
So the cash flow easily covers the yield today, and the valuation looks incredibly reasonable. But a dividend is really only safe if the leadership actually believes the company will continue to grow tomorrow. If we look at what the executives are doing with their own wallets, what does the insider trading data tell us?
Well, insider tracking is often where you find the unvarnished sentiment of the leadership, strip of all the public relations spin from the quarterly earnings calls.
And the insider data we pulled for GLP is fascinating. Over a recent 6-week period, the general partner Global GP LLC purchased an aggressive amount of stock. They didn't just make one isolated trade. They made 9 separate open market buys,
Yes.
totaling over $2.6 million, accumulating shares at prices between $42 and $45.
That is a highly coordinated cluster of buying. When the parent entity overseeing the partnership makes 9 separate distinct purchases in a tight 6-week window, that is a glaring signal of strategic internal alignment. They clearly see deep fundamental value at that $42 to $45 price band.
But there is always a plot twist when you look closely at the filings.
Always.
While the general partner was buying millions, the chief operating officer, Mark Romaine, actually executed a sale. He sold 2,065 units, which is about $93,000 worth, right around $44.80. So if the parent company is buying millions, why is the COO taking chips off the table?
It is a valid question. And it's really easy to look at an executive sale and just assume the worst about the company's internal projections. But context is the deciding factor here.
Okay, what's the context?
When an individual executive sells $93,000 in stock, that could be for any number of just mundane personal financial reasons, right? Paying a tax bill, putting a down payment on a house, or simple portfolio diversification.
Yeah, that's fair.
In fact, if you check the filing after that sale, he still retains over 139,000 units. He still has immense skin in the game. You really have to weigh that single, relatively small executive sale against the $2.6 million institutional cluster buy from the general partner.
Which is massive.
Right. The GP's buying pattern is a vastly stronger signal of long-term corporate confidence than one executive's routine portfolio maintenance.
That makes total sense. You follow the millions, not the thousands. And tracking where the millions are being allocated internally leads us to a very surprising line item. You found something in the SG&A expenses that points to where GLP is looking for its next big operational leap, and it basically has nothing to do with building new gas stations.
Yes, and this is where a traditional old-school infrastructure company really collides with the new economy. GLP isn't just spending capital on physical terminals and barges. They are heavily investing in data analytics and artificial intelligence infrastructure.
AI, really?
Yes. In 2025, their SG&A costs, that's selling, general, and administrative expenses, actually ticked up noticeably. And management explicitly stated on the earnings call that the increase was due to hiring specialized talent and paying software licensing fees for a comprehensive new data analytics effort.
So they are bringing Silicon Valley tech to the wholesale fuel rack.
Yeah.
How does that actually work in practice?
Well, think about the pure volume of information they possess. The COO noted that they generate a staggering amount of data every single day from their thousands of retail stores, their wholesale delivery trucks, and their 49 terminals.
It's a massive network.
Right. So they're building the digital infrastructure to not only organize that unstructured data, but to embed AI capabilities into their financial modeling. They want to use machine learning to solve the traveling salesman problem for their fuel trucks.
Oh, optimizing routing.
Exactly. Optimizing routing to the minute and predicting highly localized demand. And management insists this isn't just some vanity science project. It's already providing tangible operational efficiencies that actively reduce their logistics costs.
Which is incredible when you think about the sheer scale of their physical operations. I mean, if an algorithm can save them even half a cent a gallon on transportation costs across billions of gallons of fuel, that savings falls straight to the bottom line as pure profit.
Yeah.
It's fascinating. We started this deep dive looking at a blue-collar physical infrastructure company moving liquid energy through pipes, barges, and trucks. But with these new heavy investments in data analytics and machine learning, I mean, what happens if algorithms actually become their ultimate competitive advantage?
It could change everything.
Think about it. Could AI perfectly predict neighborhood-level fuel demand, optimize their rack pricing dynamically, and completely wipe out that volatile margin seesaw we saw bouncing between Q3 and Q4.
If they can successfully merge their massive physical footprint with predictive AI, that seesaw of profitability we analyzed earlier might just turn into a steady, predictable upward escalator. It fundamentally alters the risk profile and the growth ceiling of the entire stock.
It really does. It is a compelling story of physical hard assets meeting digital optimization, all while paying out a 6.6% yield that is actually covered by real cash flow. All right, listeners, what's your take on the future of GLP? Are you bullish on their Texas expansion, bearish on the long-term future of gas stations, or just sitting on the fence waiting for more data? Let us know in the comments. See you next time on the Bite Size Brief.